Good afternoon. Todd Engelhart, Regional Director of Investments, Cumberland Advisors, standing in for Matt McAleer. It is Friday, November 18, shortly before the close. This week represented a mildly bumpy pause in what has otherwise been solid market performance since the September 30 close. All of the major averages are on pace for a mildly down week, except for the Dow Jones Industrial Average. It looks as though with this late Friday rally, it may finish flat on the week. But the S&P is down roughly 60 basis points, and the NASDAQ lower by about a point on the week. However, again, all three indexes are very much positive for the month. Investors pored over the latest earnings reports, which on whole were respectable, but investors also assessed another round of tougher language from Federal Reserve speakers, which gave investors pause, feeling that the Fed did not think the economy had cooled enough. Not surprisingly, in the face of that, defensive sectors led the week with consumer staples, healthcare, utilities holding on to some gains. However, during the week, Fed officials raised more concern over tighter U.S. monetary policy. On Thursday, St. Louis Federal Reserve President James Bullard said the policy rate is not yet in a zone that may be considered sufficiently restrictive. He added that 5 to 7% may be a more appropriate federal funds rate, which is higher than what the market is pricing. From our perspective, it was nice to see that the market did not totally fall apart in the face of these comments. So rather than a glass half empty reaction, markets appear to be focusing on the actual data rather than getting caught up in the rhetoric. The markets have enjoyed a run, and some backing and filling, such as what we saw this week, should help the markets going forward. There was a fair amount of trading at Cumberland over the past week, mostly sells, some in part due to the stray rocket report from Poland. There were 3 trades in the U.S. equity ETF strategy. On Monday, we sold KBWB. As you know, KBWB is based on the KBW NASDAQ index. We held the position for roughly a month. The inverted yield curve became more troublesome to us. It negatively impacts the spread a bank can achieve through its ability to borrow short and lend long. We sold into a 3-day lift in KBWB. Also in U.S. equity ETF, we bought the iShares Semiconductor ETF. We're beginning to see some lift in semis over a long period of what had been declining stock prices. There's also reasonably high industry uncertainty given the news from Taiwan. Lastly, we made some moves in the face of the rocket, which landed in Poland earlier in the week. That certainly had the makings of rattling the markets. In this same strategy, we sold our 7% position in IJR, which is the iShares Core S&P Small Cap ETF. This was a terrific trade. We sold into a strong move, but also in response to the heightened geopolitical headlines. In U.S. ETF Core, for the same reason, we cut our SPY position, the S&P 500, in half on the recent move higher, and given the possibility of more risk-off thinking could enter the markets. We can certainly always add back. In tactical trend, we trimmed back the JP Morgan position by 2%, just a small pair back off the recent thrust higher. We'd love for you to take in Matt's Tuesday special video regarding the FTX collapse and the Russian rocket news. We're now going to toss it over to John Mousseau, who's taping remotely this week.
Hi, it's John Mousseau. I'm the President and CEO of Cumberland Advisors. It is Friday afternoon on November 18th. My colleague Matt McAleer, Director of Equity, is traveling today, so our other colleague Todd Engelhart is taking over for him. I'm doing the bond portion today. And really, when you look at this week, look at the 10-year bond. Really no different from the close that we had last Thursday before Veterans Day at around a 380. 30-year bond a little lower by 10 bips, down to about a 390. But I think what's important is that those two numbers really got their gas from the day before last week, basically on Thursday. Whereas during that day, you saw those yields drop about almost 30 basis points. And that, of course, came off the CPI number. This week, we had a good PPI number, with producer price indices coming in at around 0.2, both for headline and for core, below what expectations were, very important. And the idea is that, as we have talked, not only are the month-to-month numbers coming down, but when you annualize 6-month and 3-month numbers, those are also declining on the inflation front. The market clearly thinks that the economy is slowing down. You can tell that from the 2 versus 10 Treasury yield spread. That is up towards 68 basis points negative. Just to put it in perspective, it began November, which is only 18 days ago, at negative 44 basis points. So longer term yields down, shorter term yields, basically almost where they were. And it reflects a market that sees a slowdown coming, knows the Fed is not satisfied doing what they're doing yet. You certainly saw it this week with continued improvement in the municipal bond market. And municipal bond yields, since that great CPI number back a week ago Thursday, yields are down 40 basis points, 45 basis points in longer end. But more importantly, on really beat up merchandise, deep discount bonds, et cetera, and we've talked about it. Some of those yields are down from basically last Thursday to now, in the lines of like 75 basis points lower. It tells you how oversold the muni market is and was. And it's still cheap, but it was incredibly cheap and being given away. And why? We know because of bond fund flows. This week, if you take bond fund flows slightly negative, but look at the flows into municipal ETFs positive, I don't know whether you've turned the corner, but you're basically at $1 billion plus on the positive side. And that is a very welcome change. We don't know whether it's just temporary, but we do know as you go into the end of the year, there's going to be less supply of munis. There's going to be a lot of rollover period. We would expect some of that money, a lot of that money rather, to go be reinvested into the market. This is from matured bonds and coupon payments. And look, it can go into the market two different ways, either direct buying or it can go into bond funds and bond ETFs. So we'll be watching that carefully as we get into the middle of December. As we go forward, the next week, we have very little in terms of data. Basically, the University of Michigan will be looking at consumer confidence there. And we'll be looking also at the durable goods number. Other economic indicators continue to trend down. This week, the National Association of Home Buyers Index down, Kansas City Fed Business Index down. All this is consistent with an economy that is slowing. New home sales continue to be negative. In other words, lower than they were the month before. So none of this is a surprise, right? At the margin, obviously lower rates will work their way into mortgages over time. But remember, you also are still well elevated from where you were at the beginning of the year. We'll have a short piece next week as we go into Thanksgiving week. And we appreciate everyone watching, and have a nice weekend. Thanks a lot.
Thank you very much, John. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Have a restful weekend.